Bloomberg Audio Studios.
Podcasts, radio, news.
You're listening to the Bloomberg Intelligence Podcast. Catch us live weekdays at 10 a.m. Eastern on Apple CarPlay and Android Auto with the Bloomberg Business app. Listen on demand wherever you get your podcasts or watch us live on YouTube.
It is Fed Day, of course, and the question for a lot of investors today, obviously, is what does the Fed do here? Did they go 25? Did they go 50? What kind of rationale does the Fed give for whatever decision they do make, and what does it mean for this economy? Dennis Lockhart joins us. He's a former Atlanta Fed president, and he joins us via Zoom. Dennis, thanks so much for joining us here. How do you think your Federal Reserve will kind of act later this afternoon? What do you think we're going to hear from the Fed?
Well, my expectation is that they will opt for a 25 basis point cut, but it could go either way. I do think it's a close call, and I could very much be wrong. I have to laugh that usually I have more time for people to forget, but it's less than 4 hours until we'll find out. So I could be proven wrong very, very quickly. I think a case can be made for either move, and if the committee is sort of ambivalent, often the leadership of the chair is asserted, and in this case, Chairman Powell may state his preference, and I think then the committee will go along with that.
Why do you think, Dennis, it is such a close call?
Because I think you can make a legitimate case, and neither case is panicky or is emergency based or whatever, that 25 basis points is appropriate, or 50 with a little bit of catch up in it, and perhaps a bit more of an insurance angle to it. So I think you can make a serious case for either decision. A 50 basis point move, of course, is not the normal increment that the Fed typically cuts or raises, and it does have a little bit of a hint of panic, and I don't see any basis for that. That's why I'm opting for 25.
Dennis, if we were to see a dissenting vote today, would that be news? Would that mean anything to you? Should the market read anything into that?
I don't think so. I doubt that we will see a dissenting vote. If we see a dissenting vote, it might come from an inflation hawk who's still concerned about the level of inflation and the distance to 2%. The chair, I think, has welcomed a diversity of opinion on the committee. You've heard him say that in his press conferences. I don't think one or two dissents would mean that much. Having said that, at a momentous event like today, where they're pivoting policy in the first cut in 4 years, they would, I think, like to present a unified face, but it's not going to be a big deal if someone disagrees.
So I was in Canada, in Toronto yesterday, and I had the pleasure of interviewing Carolyn Rogers. She's the deputy governor of the Bank of Canada. And many times I tried to get her to tell me whether or not they were going to go another 25 in October. The conversation eventually came into the transmission effect of monetary policy and how it took a long time for the hikes to be felt, and then how it's going to take a long time for the cuts to be felt. How do we know what that transmission mechanism is when you have something like housing, which seems to be in a structural shift?
Well, we don't know with any precision exactly what that mechanism is. It's estimated at as short as a few months, maybe 6 months to 18 months. What is generally accepted, of course, is the idea that monetary policy has its effect with a lag, and I think there's plenty of evidence that that's the case. Therefore, the decision that the Fed makes today is not going to immediately have an enormous effect on the economy. It will take some time, and it will accumulate over the coming months.
Dennis, can you give us a sense of how this Fed may proceed over the coming meetings over the next several quarters? Is this something, in terms of the cadence of the cuts that they make, is this something they want to do in a chunky style? Do they do 25 basis points every meeting? How do you envision that taking place?
What I would expect would be a methodical, deliberate approach that doesn't bring a lot of surprises to the financial markets. The communications challenge around chunkiness, to use your word, or pauses and then a resumption and 50 versus 25. That requires some very, very skillful communication, and not in order not to create unnecessary volatility. So I think once they've started this, they'll stay with a base case of 25 basis points at each meeting until they feel it's time to pause.
So based on that, the futures market is really outpriced for that. So we're still looking at over 100 basis point cuts so far for this year if you take a look at WIRP. So if it's a 25-25 kind of scenario, we still have to price out as much as 35, 40 basis points of cuts. How do you think that Jay Powell does that? Or is it the dots?
Well, he's not going to commit to much in the way of a path of policy other than perhaps saying something general, is that the expectation of the committee is that there will be further reductions in the policy rate. And certainly beyond the end of the year, I think he'd be very careful about committing to anything. But I think in speeches and in Fed speak in general, you'll get some sense that, and of course in the summary of economic projections, which will be published today, you'll get some sense of what they're thinking. And I suspect what you're going to see is that they're thinking of 75 basis points by year end. So the markets are going to have to adjust that thinking, or the markets often have their own point of view.
Do you think the timing of these Fed cuts is appropriate here, Dennis, or do you think perhaps this Fed might have been at least a meeting maybe too late in terms of starting this process?
Well, according to the minutes, there was a pretty serious discussion of the first cut being in July. They decided to defer that. One reason they did is because the interval between the July meeting, the September meeting, is the longest on the calendar, and they get quite a bit more information in that 8-week period than they get in a 6-week period, for example. So I think they decided to hold off for more information. So what Jay Powell said at Jackson Hole, that the time had come, boy, you really can't be very more definitive than that. Mm-hmm. He had to be very confident that he could lead his committee to this decision today. And that's probably because of how seriously they took the idea in July of making a cut in July. So to answer your question, maybe they're a meeting behind, but in the greater scheme of things, I don't think there is great danger associated with maybe being a little bit behind.
All right, Dennis, thanks a lot. We truly appreciate it. We appreciate all your insight on Fed Day. Dennis Lockhart, former Atlanta Fed president.
You're listening to the Bloomberg Intelligence Podcast. Catch us live weekdays at 10 a.m. Eastern on Apple CarPlay and Android Auto with the Bloomberg Business app. You can also listen live on Amazon Alexa from our flagship New York station. Just say, Alexa, play Bloomberg 1130.
Joining us now also in the studio is Olaolu Aganga, a U.S. Chief Investment Officer over at Mercer. Okay, do you care about 25 or 50 today, or how are you looking at this monumental decision at 2? And she's laughing at me already.
I'm laughing because there are two things. Firstly, it's monumental because it's the first rate cut in years, so that's the big thing. But is 25 basis point going to move the needle? Unlikely, right? Is just the direction that we're happy about. We're finally moving.
All right, so you got your MBA from Stanford. I'm not sure if you're aware, but yesterday Bloomberg Businessweek magazine came out with their rankings of MBA programs. For the 6th year in a row, Stanford was number 1.
Woo, woo.
Duke was 12. I don't know what they're doing down there at Businessweek, but I have to go have a talk with those people. But all right, so talk to us about the business at Mercer. What are your institutional clients? What's changing these days, or maybe in the last 12 to 18 months, about where they're allocating capital these days?
So, we're talking about the rate cut. Is it a big deal? It could be, and it could be for defined benefit pension plans.
There's
because
still those out there?
They are still those out there. I mean, a lot of them have benefited from the equity markets, right? So, that's been great. But in a lower rate environment, the liabilities could become more valuable. So that's what we're watching, right? Are you appropriately hedged? But then they have great equity portfolios. They have private equity portfolios that have done well. And they've moved into private markets across the board.
So what is that rate threshold, right? Because we're not going back to zero.
Yep.
So if it goes to 4, is that where allocations start to change? Or is it 3? How do you look at that?
So I'll give an example of just the real estate capital markets, right? So financing has almost ground to a halt. It's really hard to finance things. Developers are having a hard time. They had 1-year interest rate type hedges and they're not moving. So an indication there of when things start working is rates low enough to get that to unfreeze the real estate capital markets. So it's great for mortgages, it's great for lending, it's great for borrowing, all of that stuff. So we start looking at activity in some of those other areas.
Private credit. Alix and I were just fascinated by the growth of private credit. How does that impact your institutional investor clients? Are they asking you to get more exposure to private credit, and how do you do so?
Private credit definitely has been one of the areas that's benefited from the higher rate environment. It's floating rate. So the debt covenants and the negotiations that happen there mean that even though it's not syndicated loans, not publicly traded, there was more protections there. So lots of capital that was flowing into just senior direct lending. So clearly, as you're moving into a lower interest rate environment, could that be impactful? Yes, but on the senior direct lending side, there are other aspects of private credit that are attractive.
What other areas also in private credit? And then also, side note, in terms of, say, commercial real estate, I know that's not private credit, but in terms of an asset class, it's been really messed up.
So I'll say from a private credit standpoint, opportunistic credit. So some of the more distressed opportunities where senior direct lending, it's still relatively good. So the opportunistic credit space is great. They have more equity-like properties. But to your point, if you go to something like real estate valuations, especially core real estate, has been stabilizing outside of office. And office is a different category in and of itself, because if you start looking at newer office buildings, older office buildings, what kind of rehab is there, the rental, everything. So office is still a little challenged, but for the most part, core real estate valuations outside of office has been stabilizing.
I guess one of the challenges there for real estate, we've heard from other folks in the real estate business, because Alix and I like to talk to as many people in that commercial real estate business as we can, is just the banks aren't quite as constructive on real estate, commercial real estate, as maybe people would like. So it's tough to find financing. Maybe you can get it at the private credit market, but you can't just go to your relationship bank and necessarily get a mortgage on a big piece of commercial real estate.
Real estate is definitely the area that's taken one of the hardest hits with the rise in the rate environment. To be frank, again, it's painted almost with a broad brush. It truly is office that's having the toughest time. Valuations in other areas has been challenged as well, but it does look like it's starting to stabilize.
What other trends are you seeing right now in terms of interest, money flow, questions, worry spots?
So there's been a big focus with regards to infrastructure. And this started some time ago when we started seeing the capital flows from the Inflation Reduction Act, and finally dollars going to work there. So that's a focus as we're going into the election. It's also a focus to see if some of those trends stay. So that's one. Private equity has always been an area of focus. However, venture capital that a lot of clients were very focused on, the new innovative types of areas, had slowed somewhat because from a capital standpoint, that's the longest time to get your money back. So venture has been, real estate has taken a hit, venture has taken a little bit of a hit as well.
How about just the big tech trade, the Magnificent Seven trade that John Tucker's been in for the past 2 years? He's just clipping coupons on the way to the bank. Is that still a thing, or do we have to go look for other areas of opportunity in the marketplace?
It's The talk about the Magnificent Seven, it becomes six or what have you, I keep saying it is really because of the index construction, right? So the weight in the index is what makes it the big focus. It lifts up everything. But if you remove them and look at the rest of the index, like we've seen some decent returns. Of course, earnings growth coming out of the earnings season was good, but the focus on the seven was because of the weight in the index. So these types of rotations happen.
But the theme of it, in terms of AI, which also goes back to your infrastructure play too, how do your clients then not straight up in NVIDIA or the equity market? How can they invest in that trend?
I mean, right now, from a publicly traded standpoint, right, there are only a few limited options. However, from a private market standpoint, there are lots of capital that's going into new and innovative companies. It still is venture. It's a longer-term type of trend. What we are seeing is investigating. From an AI perspective, there is efficiencies, right? So from redundant type of tasks, but what are we really going to get from a benefit standpoint? There's a lot of work going into it and seeing how you can integrate it into your day-to-day. But more private equity and venture investments to get into AI, and then there are only very few from a publicly traded company standpoint.
Didn't we see Microsoft yesterday unveiling that AI infrastructure fund?
With
BlackRock?
BlackRock. Right.
Yeah, I mean, it's a huge amount of money.
Yeah,
so
exactly.
speaking of that non-public opportunity.
Yeah, I thought the biggest tech trend was me upgrading my iPhone.
Okay, can we just say, so I put my phone down next to Paul. I've had my phone the entire time he's known me. And because he ordered this new iPhone 16 Pro, he looks at it and starts judging it because he has a chip. So now he's become an iPhone 16 Pro snob.
I'll say my husband does the same thing, really. He's
he
like
judges your phone?
He judges my phone, and then I'll get a new one and like a hint to change my phone.
Exactly.
Yes.
See, that's a tech cycle that you can use, a replacement cycle. All right, in the fixed income space, I don't know. I mean, 2-year treasuries, 3.65%. It's not the 5% I had a few months ago, but it's still, for no risk, that's a pretty good return. Do I do that, or do I take credit risk?
So to your point, it's not the 5% that it was before.
Yep.
Right now, here is, we're at current levels, but we know the direction is lower. Right. So it's how long are you going to be able to sit on that? For as long as you can, that's great. But for our investors that are more institutional in nature, longer term, they don't typically turn over their portfolios as much. So if you're focusing on the long term, you go to the spaces that have a little bit more longevity in where you can get rates. So they were shorter duration at first, maybe a few years ago, and that's moved. They're now invested in equities, private credit, to your point, and looking at areas where valuations were depressed. So real estate is an area now that we are looking closely at.
So when you mention the areas that have growth, a lot of it does tie into fiscal policy, and then obviously that becomes like an election risk, et cetera. But is this time different? Oh God, I hate that I just said that. And that there's so much fiscal coming out of DC, regardless of who wins in November, and no matter who wins, there will be fiscal spend on stuff. And this is in comparison to, say, Europe or even Canada. How do you look at that divergence?
So we spend a lot of time looking at the policy or potential policy that's being discussed, because the elections are important. Of course, they're important. But the more important thing is, can you get anything through? So what's the makeup of the House? What's the makeup of Senate? That will truly drive and determine what we can do on a go-forward basis. So we're watching some of those, more local type elections as well.
It's funny, they were interviewing somebody from BNP Paribas, strategist there this morning, and they had a great flow chart in their piece of research. It was basically if-then kind of thing. So if if it's, the economy's good, if the economy's bad, if it's Democrat, if it's Republican, here are all the possible outcomes and they kind of how to play it there. And it's just kind of made it very clear. So again, at the end of the day, you can't really hedge political risk, can you? So it's just, so I guess the question becomes, can anything actually get done once whoever is in the White House is in the White House?
That's the point. So whoever is in the White House, and then can they get anything done?
Right. In the interim, we wait for the Fed at 2:00.
Yeah, and then after that, then what?
Exactly.
Then what are we going to talk about tomorrow morning? What
Exactly.
the Fed did.
What the Fed did. That'll
what
give us
about
another
Friday?
24 hours. I don't. There's some economic data coming up.
You can drag it out for the week.
There'll be some earnings. Olaolu Aganga, Chief U.S. Investment Officer for Mercer, joining us here in our Bloomberg Interactive Broker Studio.
You're listening to the Bloomberg Intelligence Podcast. Catch us live weekdays at 10 a.m. Eastern on Apple CarPlay and Android Auto with the Bloomberg Business app. Listen on demand wherever you get your podcasts or watch us live on YouTube.
We've got some news in the global aerospace airline business. Looks like Alaska Airlines, the Jerry Garcia airline. And Hawaiian, the merger, looks like it's going to be cleared to close.
It's
as the
an
Department of
Eskimo. It's an Inuit, please.
Now I understand that. George Ferguson, he knows all this stuff. Senior Aerospace and Airlines Analyst for Bloomberg Intelligence. So, George, what's it mean for Alaska and Hawaiian to get approval here? Where does this combined entity go? How competitive can it be? Is this a good deal?
Yeah, so I think it's a good deal for the U.S. consumer, because I think there was a risk that potentially Hawaiian could have gone out of business. And so I think really what this whole thing adds up to is Hawaiian was a bit distressed. They've had some problems in their core businesses, especially from wildfires, Japanese travel, things like that. It just hurt their core business. Their balance sheet was stressed. And so Alaska coming in and taking them over, assures that they continue to exist. The combined entity has a footprint that looks like, or a route network that looks like West Coast U.S. into Alaska, and then Alaska has some long haul into Asia. So it makes Alaska's operations a little more complex with some long haul, wide body aircraft. For most U.S. consumers, they're not going to really be able to tell, but I think the U.S. Department of Transportation, Department of Justice figured out that, like the Spirit JetBlue merger, purchased by JetBlue, whatever you want to call it. I think letting that fail means that Spirit's in difficult straits. Hawaiian would have been in a similar place, and I think they've decided, let's just let this go.
Does this mean that the Spirit deal could get another look through, or that's definitely dead?
I think that's definitely dead from a JetBlue perspective. I'm not sure if Justice would think differently about it now, but I think it's dead.
George, what's the current status of just demand for air travel these days? What are the airlines saying these days?
I mean, what we saw in 2Q was that budget travel definitely looked like it was taking more of a demand hit. Although, it looks like some of those travelers are fading a little bit, and I say although because we saw a bunch of capacity come to that marketplace, right? And I think really what we're starting to see in 2Q of this year was a fading of this bounce back travel boom where people were paying anything it took to go on vacation. And so I suspect we're going to continue to see that as we get into 3Q. We're actually working through schedules right now for the U.S. airlines as we do as we close the quarters down. And we're still seeing a decent amount of capacity coming to the marketplace. When I say decent, we were looking at domestic the other day, 5-6% growth in seat capacity, and you really can't do that in a market that the U.S. economy is growing a couple percent, and you don't have this bounce back travel. So we still think 3Q looks soft-ish. It's not as bad as 2Q. Some of the capacity growth isn't there. We're seeing more capacity growth come in from the big full-service carriers than we're seeing for the budget low cost. And notable are carriers like Southwest and JetBlue literally pulling back in capacity as they go into the end of the year.
Right, so you have the big guys are able to compete a little more on capacity and then price, and then the other guys can't, and that gets confusing. So this is a dumb question, but if I take a look at the big guys, can you rank these for me here? So you get the Delta, American, United. They're going to be the top three, right? What comes after that now?
Southwest. Southwest is number 4.
Okay.
One of the biggest carriers in the country.
And
then you go into the Alaskas, JetBlues, those folks. Sorry.
So did Alaska and Hawaiian Airlines help them get a big boost? Are they in the top 5 now?
Well, Alaska is going to be 4 or 5, and JetBlue is going to be at 4 or 5. So the Alaska-Hawaiian combination probably jumps them a bit above JetBlue. I haven't looked at this recently. JetBlue is going to be number 5 if they got Spirit, and those two are kind of neck and neck. So my guess is they're slightly ahead now, Alaska.
All right, George, what we got on your phone? We need our periodic update of Boeing. I know the most recent news was Boeing freezing hiring to preserve cash, and what's the update on the strike and kind of where we are with Boeing?
So it goes on, obviously. Folks are talking. I understand that there's a supplier discussion going on today out in the Pacific Northwest. I think as Boeing starts to brief suppliers. If it continues, I suspect that Boeing's draw off suppliers, their offtake of the components they're building is going to have to slow. To continue to preserve cash, I just don't see hiring doing that much for the cash flow of Boeing, because again, as it drags on, they have to start to really worry about how much cash they're burning. They would prefer not to go back to capital markets to shore up their balances. We think they're probably going to be close to $9 billion in balances as they end 3Q, and that's going to be pretty tight because that's roughly around what they say they need to run the company. I'm sure everybody can tighten their belt, every company can tighten their belt and get lower, but they need to be very, very mindful of cash burn here.
Yeah, I was like, ooh, that's treading the line there. We was talking to the guy over at Moody's who is putting the company at risk on downgrade. If they get a downgrade from like Fitch, S&P, and Moody's, like, what would that mean? That would be huge, a huge fallen angel, right?
Yeah, it's a big fallen angel. I mean, it's not the end of the world, right? Companies manage through this. No, I mean, it means that you're going to go to capital markets. If you go to debt markets, it's just going to cost you more to raise, right, your debt. And a company like Boeing needs this good mix of debt and equity to make the returns work for the equity. And so you kind of hate to be paying higher interest rates. You're going to see, some funds that are debt funds can't hold less than investment grade paper. They'll end up having to disgorge some of that Boeing paper. That means that you'll see prices gap out in it. Again, it's not the end of the world, but you prefer to be raising money cheaper than what they will be in the high yield markets. But customers, I don't think, go away because of it. Nobody can break their commitments for airplanes because of it. Suppliers don't really have other places to go for aerospace business, right? They could go to Airbus, which is investment grade. And Boeing has to continue to rebuild that balance sheet as they get things like this strike past them.
All right, George, we appreciate you. Thank you very much. George Ferguson, Bloomberg Intelligence Senior Aerospace, Defense, and Airlines Analyst, joining us there.
You're listening to the Bloomberg Intelligence Podcast. Catch us live weekdays at 10 a.m. Eastern on Apple CarPlay and Android Auto with the Bloomberg Business app. You can also listen live on Amazon Alexa from our flagship New York station. Just say, Alexa, play Bloomberg 1130.
Jon Caplis joins us. He's the CEO of PivotalPath. Joins us here in our Bloomberg Interactive Broker studio. Jon, real quickly, just tell us what you guys are doing over at PivotalPath as it relates to the hedge fund business.
Sure. Well, thank you, Paul. So we are a hedge fund research firm, and we work with some of the world's largest hedge fund investors, endowments, pensions, sovereign wealth funds, to provide them with the most comprehensive set of data, information, and analysis so they can source hedge funds, evaluate them, monitor them, and benchmark them.
Where is the money going to within the hedge fund asset class? Where's that money been going to most recently?
Sure. So hedge fund as an asset class is a bit difficult because they trade all asset classes. So if we were to focus on the equity strategies in particular, just like the markets, they have made a significant amount of their returns on the heels of Magnificent Seven and a lot of big tech. Going into this Fed rate cut, they certainly are more bullish than they have been over the last couple of years. And that means that a larger than expected rate cut is probably going to benefit them in general.
Okay. So, I mean, as an asset class, how do you frame out for your clients how they should use hedge funds, how it should be part of a diversified portfolio?
Sure. So again, that's kind of the difficulty of calling it an asset class. It can be, but in reality,
what's the better way to phrase it, do you think?
Well, it's trading strategies across many asset classes, right? So when you look at long-short equity, many of our clients, large pension funds, they consider it an extension of their equity portfolio.
Got it.
When they look at fixed income relative value or long-short credit, it's often an extension of their fixed income portfolio. For other diversifying strategies like global macro and managed futures and multi-strats, it's going to have a different type of role in the portfolio to maybe minimize downsides, provide uncorrelated sources of returns, and hopefully alpha.
One of the things I've noticed being on Wall Street since the mid-'80s is just A, the growth of hedge funds, but B, seems like the consolidation. That you got, if you're a big like Millennium or Citadel or Point72, you can get money, tons of money. It flows there. But if you're like the hotshot trader at Morgan Stanley who's had 3 or 4 years and wants to go out and raise $1 billion, that doesn't seem to be as available today as maybe it was 20 years ago. Are we seeing too much concentration, do you think, in the hedge fund business?
So I think it's a great question, and I think the answer was yes. Up until about a year and a half ago, We saw the new launches for hedge funds significantly down. We saw new capital for emerging managers significantly down. That has all actually changed. We're seeing a huge trend this year where we're tracking almost 150 new launches in 2024 into the second quarter of 25. But more importantly than that, these new launches come from hedge funds that are above $1 billion in assets. So in terms of pedigree, we're seeing significant amount of quality launches. But in addition to that, a lot of the capital that they're receiving is actually from the multi-strats themselves.
Yep. And we actually have a Bloomberg exclusive story out on the Bloomberg terminal today. Millennium Citadel breed a $14 billion pack of hedge fund cubs. So it was just like Julian Robertson from Tiger seeded all his cubs. Now it's Ken Griffin and Izzy Englander from Millennium.
Seeding all the cubs. Wait, so is that just because there's just more money out there, or like why is that? So you basically have the big guys and investing in the little guys and the whole thing. Like why are we seeing it like that, and what kind of strategies?
Yeah, I mean, there's a number of reasons. I'd say one of the primary reasons is that the institutional investors themselves are starting to, based on multi-strat performance that actually has been slightly down, not very much, but slightly down, and also relative to a higher risk-free rate, they've been looking to create more transparency, and doing that through single strategies. It's a lot easier to understand a long-short equity strategy focused on technology than a multi-strat that may have 300 different PMs in it. So part of it's the investor base that's pushing that. The other part of it is that the investors are also wanting reduced fees. And running these large multi-strats is extremely expensive. Part of that's for signing bonuses, retention bonuses, and things like that. That's part of the biggest amount of overhead that is often passed through to the investors themselves. And so a lot of these PMs who have done extremely well inside of these pod shops or multi-strats are now seeing an opportunity to spin out, maybe change their quality of life a little bit. And the multi-strats themselves are saying, you know what, we should actually fund that and be a part of that as opposed to losing that talent. And in fact, they can do so and win in the same time because they can invest in a separate account and they can still have control, but also reduce their overhead costs and the fees that a lot of their investor clients are not happy with.
I don't know, for me, one of the biggest pieces of news in the hedge fund business, really was just over the last couple of days, was Steve Cohen announcing that he was going to step away, I guess, from active management of his funds. That must have been a buzz within your industry. What are people saying about that?
Absolutely. I mean, he's definitely one of the pioneers in the industry. He's one of the most well-respected investors, for sure. Yep. One of the issues in the hedge fund industry has always been succession, right? Can you get past the founder and get to the next generation of talent and continue to build a high-quality institutional business? And that's something that we still haven't seen that many examples of. So, he says he's going to obviously stay involved in the business, and that's public information. But we're always looking to see, can that next generation of talent manage the business, continue to grow assets, and continue beyond their founder?
What kind of strategies right now are doing well? Like, what are hedge funds broadly doing? How are they positioned? Like, what are some of your big takeaways on that?
Yeah, I mean, there are a number of hedge fund strategies doing well this year. And
more
in general,
than just owning NVIDIA?
Well, the TMT, or Technology, Media, and Telecom Managers, absolutely. That's been a big part. And companies in similar, have that AI exposure. But beyond that, we've also seen financials come back, and as we've seen in the market, with the market goes, a lot of the hedge funds, because they are often long biased, especially in sector-focused strategies. So financials is leading the way. Healthcare is also a very strong performer this year, and these are sector-focused managers in biotech, in pharmaceuticals, but especially biotech. And then outside of that, the multi-strats continue to do well. They're up about 7% year to date. That's well ahead of the risk-free rate, and it's all uncorrelated. Lastly, it's the equity quant managers that had been kind of left for dead after 2020, where they had a 5-year period of generating almost no returns. Over the last 3+ years, they've been annualizing over 9.5%. Again, uncorrelated, purely in the form of alpha, and so investors are turning back to systematic and quantitative managers as well.
And just broadly defined, money's still going to hedge funds, right? Is it still a net inflow year after year?
So this year, not really.
Okay.
But it's not for a lack of interest. It's actually much more related to the lack of distributions in private equity. All of the clients that we speak to are actually more interested in hedge funds because they performed so well since COVID, and because of the greater liquidity that they offer. And so we're seeing, even from private credit, we're seeing for the first time, surveys are now telling, and our clients are saying the same thing, that they're more interested in the liquid side of credit than in private credit. Same thing in private equity. They're starting the pendulum swinging back towards public equities. The problem is a lot of these investors lack the liquidity to do so. So assets are not really growing that much beyond organic returns. And in addition to that, even though I've talked about all these new launches, the capital is oftentimes being recycled from those multi-strats themselves as opposed to new capital flowing in. But the interest is there.
All right, Jon, really interesting stuff. Really appreciate chatting with you. I noticed that you and your firm were represented in this Bloomberg article citing your research. Jon Caplis, CEO of PivotalPath, give us an update on what's happening in the world of hedge funds.
You're listening to the Bloomberg Intelligence Podcast. Catch us live weekdays at 10 a.m. Eastern on Apple CarPlay and Android Auto with the Bloomberg Business app. You can also listen live on Amazon Alexa from our flagship New York station. Just say, Alexa, play Bloomberg 1130.
It's Fed Day. In case you haven't heard, you got yields a little bit higher, stocks going a whole lot of nowhere. Joining us now for his take is Jeffrey Cleveland, chief economist over at Payden Rygel. All right, Jeffrey, 25 or 50, place your bets.
25.
Why?
I don't see the urgency to cut by 50. I think, stocks are at all-time highs. Layoffs are quite low. We had a decent retail sales report yesterday. So usually if the Fed goes faster, it's because we're in an obvious financial crisis or we're in a recession. And I don't think you can make either of those cases or of those arguments. So it seems like 25 would be the best path here. But I don't want to protest too much. I mean, I think we're going to go middle of next year. We'll be, 4% on Fed funds. End of next year, end of 25, we'll be at 3.5%. So they want to go faster. I won't protest. It's good for stocks, good for bonds. I like it.
Jeffrey, what do you think, aside from the actual, move on the rates, what are you going to be looking for from the messaging, from the body language and all that kind of parlor game that folks play? What are you going to be looking for in this meeting?
Well, probably first the dots. As of June, we had one cut for this year, and then we had about 4 next year. So look for the change in the median dot where they see the policy rate this year and next year. That's possibly some disappointment for the market because market already expects a lot of cutting out over the next 18 months. I don't know whether that's going to be confirmed by the dots. So
well, exactly. So are we just looking at like a bond sell-off if they go 25 and don't confirm almost 5 cuts this year?
Yeah, potentially because the bond market, it's like at the beginning of the year, Alex, the bond market was expecting 7 rate cuts, I think, at some point in January. So far, we haven't had any rate cuts, so the bond market was wrong about that. So in the short run, yeah, that could cause some volatility. So that's an issue today. I think also the messaging. I think if I was going to build a case to cut more quickly, I would just say, hey, the inflation threat is gone, and the real threat now is economic downturn or further labor market weakness. And then I would say to everyone, hey, we don't need to be at 530 on the funds rate. If inflation is not a risk, we need to get back to neutral, and we want to get there more quickly. That would be the argument, I would say. So how the Fed chair tells the story today in the press conference will also be important to take in.
So, Jeffrey, is it your belief at this point in time that the economy is, in fact, in decent shape? Yes, maybe slowing certain parts, but in decent shape?
Yeah, absolutely. I mean, layoffs are low. I think GDP in the current quarter is tracking 2.5%. We think for the full year we'll be almost 2.5% on GDP, Paul. The unemployment rate's at 4.1, 4.2%, we think, at year end. So that is still a great environment. Now you got the Fed cutting. So this is very bullish for risk assets, I think, over the medium term. Great for bonds, great for stocks.
Where in stocks, though? I think it was Bank of America, but saying this is a great point for mid-cap stocks because you get the valuation boost from small caps without kind of the risk and the slowing sales growth, but you don't have sort of the top line like you would for large cap.
Yeah, I mean, I think that's a decent argument. I just think that really for me, and if the business cycle has more room to go, then stocks will continue to make new highs, especially if you have now a supportive Fed. So that's the lesson of history in all the different business cycles. When you get to the end of the business cycles, when you really want to get worried about equities and maybe get more defensive, I don't think we're there yet in the next 6 to 12 months. I think the economy will continue to grow. So more like, I guess, a 1990s style soft landing. That would be what I envision for the economy.
Hey, Jeffrey, how about the U.S. labor market? That's obviously something that the Fed looks carefully at here. What's your kind of take on where we are with the labor market?
Well, everyone's been talking about the unemployment rate rising. So in our view, that has happened, but it's due to a, perhaps good reason, expansion in labor supply. That has helped the Fed, actually, because that has eased some of the labor supply demand mismatch. Wages have cooled a little bit. I think from a central bank perspective, they like to see that the labor market is in better balance, but it has pushed up the unemployment rate a little bit. I don't think the labor market it's definitely, job growth has slowed, but we're still seeing a decent enough job growth when you look at the 3-month moving average of non-farm payrolls to keep, I think, downward pressure on the unemployment rate. So when you look at our forecast out into the middle of next year, still have a pretty low unemployment rate, right around 4.1, 4.2%.
Okay, but that's the case. Then why do we need 9 rate cuts?
Yeah, I mean, I don't think you need 9. I think you could build, in our model of it, you can build a case for, let's say, 325 basis point cuts this year, Alex, and then 2 in the first half of next year. So more like 5, not 9. Why? Because you don't need to be at 530 on the funds rate if inflation is continuing to moderate. You can take your foot off the brake a little bit, if you will. So, but 9, I can't get on board with 9 rate cuts at this point.
All right,
that's
Jeffrey.
A much more calamitous situation, I think, that some investors have in mind.
Yep, that sounds about right. Jeffrey Cleveland, Chief Economist, Payden Rygel.
You're listening to the Bloomberg Intelligence Podcast. Catch us live weekdays at 10 a.m. Eastern on Apple CarPlay and Android Auto with the Bloomberg Business app. You can also listen live on Amazon Alexa from our flagship New York station. Just say, Alexa, play Bloomberg 1130.
Let's take a look at some of the regulatory aspects for M&A. Jen Rhee, Senior Litigation Analyst for Bloomberg Intelligence, joins us here. Tapestry-Capri. What's going on with that big deal?
Yeah, a deal that a lot of people were surprised that the FTC sued to try to block. This wrapped trial yesterday. It was about an 8-day trial, and closing arguments are coming up on September 30. I think the judge wanted a little time in between to look at the evidence. And this is all about 2 companies that would bring together handbags of the brands Coach, Kate Spade, and Michael Kors.
Oh, of course.
And yes, exactly. And the FTC is concerned that means they would have too much market share in an overly concentrated market for what they call affordable luxury or accessible luxury handbags.
I mean, whatever. Capri has Versace and Jimmy Choo. I appreciate they're not handbags, but come on now. So what do you think is going to happen?
It's funny. I went into this thinking that the FTC would win, and I came out after trial. I sat through most of it, now thinking that the companies will win. They did a really good job defending the market. And, the reason initially I thought it could go to the FTC is because it appeared, at least superficially, that they had a lot of documents that showed that these companies really only considered each other when it came to pricing and promotions and innovation with the bags and changes in the bags. They suggested they had a lot of data and evidence. It seemed that they would, but it just didn't really come out in trial. And what we heard from witnesses was really compelling testimony about how dynamic and changing the market is, how much competition there is out there, fairly easy entry for mom and pops or for somebody who has a bag that's held by a celebrity on TikTok and now you blow up. And that they really don't think that there would be any ability to raise the price of the Michael Kors bag post-acquisition.
Definitely not. But that's just my personal opinion.
Can you buy one? You can't buy these bags on sale ever, can you?
Yeah, you can.
You can?
Yeah.
Oh, yes.
Absolutely.
Yeah, that's part of the issue. The Kors bags have been on sale for a couple of years now because the Kors brand has lost what they call brand heat. In other words, the consumers don't think it's that hip anymore or that cool anymore. And so they've had to reduce the prices for those bags in order to get them to sell their product.
Kate Spade, same thing. Like Coach, same thing. Yeah, I
You
remember.
can buy all these bags on Canal Street, by the way. I know a guy.
Exactly. And you know what? That's one
true.
of the points here is that when they calculated what the market shares would be and what the concentration would be, they completely left out any sales of pre-owned handbags, which is kind of a really burgeoning market right now. I mean, even Dillard's has a section for pre-owned handbags.
Dillard's has a section for pre-owned handbags?
Yes, they do. And Alex, if you believe it, what we heard in trial is that those sales outstrip the sales of the new handbags.
Wow. So
Okay.
you learn something new. She's going to the
Well,
website now.
I'm just. I never thought of Dillard's as like a high-end fashion place. So the fact that they'd have sort of recycled handbags is something.
I was talking about fakes, by the way.
No,
Yeah.
we know. We
Yeah, we
know.
know.
We just ignored you. All right, Jen. Thanks a lot. We appreciate that, Jen Rhee of Bloomberg Intelligence. She is our antitrust expert. Joining us on that. Also, we got to take a look at Kroger-Albertsons at some point as well.
This is the Bloomberg Intelligence Podcast, available on Apple, Spotify, and anywhere else you get your podcasts. Listen live each weekday, 10 a.m. to noon Eastern on Bloomberg.com, the iHeartRadio app, TuneIn, and the Bloomberg Business app. You can also watch us live every weekday on YouTube and always on the Bloomberg Terminal.